All right, away we go. Thanks very much, everyone, for joining us here for part two, which I'm sure will be a very cracking webinar, just as good as the first one. Hey, Trish?
Yeah, definitely.
Yeah, brilliant. So once again, you're joined by me, Drew Flaum of MUNROS, and Trish Matuziak of Leading Edge Finance. I think everyone can actually see you at the moment, Trish, rather than myself. Which is great because you're the first up to just reintroduce yourself, because there are a few people here who didn't join us for part one.
Sure. Hi everyone, so my name's Trish and I'm a mortgage broker at Leading Edge Finance, and the reason I'm here is to help sort of navigate some of the issues around home loan refinancing, and to give you some hints and tips on your home loan to hopefully save you some money. I was chatting to MUNROS myself, and it was sort of mentioned that, hey Trish, some of our clients might benefit from some of your advice. So here we are today, and yeah, thanks for having me, Drew.
Thanks for being here. And Trish, you know, around that, people can benefit from what you know and everything. Mm-hmm. You were just telling me not too long ago a great story, a great savings of what you've achieved this week for one of your clients. You want to mention? I think this is this is a great story.
All right, I'll elaborate. So yeah, one of my customers was due for a review on their home loan, and so I jumped on and got some pricing there with Bankwest. Got some pricing and had a look at what they were currently on, what they could potentially go to, and yeah, made the phone call and spoke to my client, let them know what's happened over the the last 6 to 12 months with interest rates, and we ended up by saving them over $3,000 a year just in interest on their mortgage. So we worked it out for 3 years that they were going to save. Sorry, it was actually a little bit more than that. It was $5,000, but we kept some of it variable. So yeah, they're just going to save over $13,000 over 3 years worth of interest. So they're absolutely stoked. And yeah, it was just a simple phone call to them, looking at options, and there's not too much change in their circumstances over the next 3 years. So they've got young kids, and yeah, not too many changes. So we decided to lock in some of their home loan and keep some of it variable. But yeah, it's huge savings for them, and that goes to paying off their mortgage and the end result being debt free sooner. So yeah, no,
it's a fantastic result. Yeah. Yep. $13,000 in savings just from a phone call from Trish.
Yeah, that's it.
Everyone should be calling you Trish.
Yes, they should be.
It's let me check. Brilliant. I'm spotlighted. I'm pretty sure everyone can see me now. That's fantastic. All right, on to my slide here. I think most people know me, but if you don't know me, I'm a director here at MUNROS. I love helping people make more profit, pay less tax, and live happier lives. The happier part's a really important part. I'll tell you what though, I wasn't too happy on the weekend. The Eagles did terribly. Not the best restarts of the AFL. So I'm really hoping they do a bit better this weekend.
I know, and they're playing Gold Coast too.
Yeah, well, you didn't have to mention that.
Sorry.
Okay, yeah.
Sorry about that. I'm an Eagles supporter too, but yeah.
Right. All the Fremantle supporters are having a good laugh.
They are.
Yeah, but yeah, fair enough. Okay.
Let them laugh away.
I thought, I wasn't going to go into as much detail about what MUNROS does, because most people know. But I thought, not everyone knows what MUNROS' purpose is, which is to help ambitious business owners and investors change lives for the better. I think that's incredibly important. It's about changing your life or your customers' lives, or whoever you want to impact as best you can, and we're just here to help with that. And that's why we do like webinars like this, because it can have a meaningful impact on you. And on purpose, it's fantastic, because I was actually having a chat with you, Trish, a few weeks ago when we were planning this webinar.
Yes.
And I just found it, it was so great when you were like, I found what I love doing, and you're just so passionate about it.
Yes.
And I think it comes across even from the conversation we're having earlier about how I had a friend that said, oh, you should need to speak with Trish. Mm-hmm. She's looking into getting her first home. So Trish took the phone call, as great she is. And Trish actually said, maybe you want to look at going with someone else here because of the specific circumstances. But that's how good you are at what you do. You're not just there, you're like, you could take that client on, but you're like, oh, I'm not necessarily going to get the best result for you.
That's right.
So I'd rather you look at this.
Yeah.
So that's fantastic.
Yeah, gave her all the details about, where she was looking at a couple of options and then also looking at me. And I said, actually, you're better off staying with who you're looking at because you're going to get a better deal with them. They were actually, the finance arm was through the builder and they were able to finance in a lot of the costs associated with building. Whereas when you go direct to a lender, they've not obviously got the building contract and whatnot. So in that instance, it was, 100% better for her to stay where she was. So
and I think, only people who are really following their purpose and know what they're doing, why they're doing it, would do that. So that was just fantastic. So I thought definitely got to mention that. And on mentioning about Munros, I'm always on about our 5-star reviews, very proud of them. And I particularly wanted to mention this one. It just came through in the last week, and I thought it was a cracker. For Mike, it's by Julian. Mike assisted our farming with our farm succession planning. Thanks to Mike's in-depth knowledge on this subject, this process has been smooth and amicable. We highly recommend Mike. It's fantastic. Trish, Mike,
yes.
He's the go-to. He knows everything there is. And it was stoked to see that come through. Really well.
And can I just add to that as well?
Yeah.
I work odd hours and, I'm always on my computer and doing bits and pieces. And the other night I was just tidying up some loose emails and whatnot. And I get an email pop through from Mike. It was about 6:30 at night. And I thought, it must be some marketing email that's defaulted to come out at 6:30 at night. And lo and behold, it's Mike, giving me a little bit of information that I needed to know. So it's really nice that, it's not a 9 to 5 business. It's after hours and, those, little extra emails here and there where that they're a genuine email. It's really important, and that's what I'm about too. It's making sure that when I go to sleep at night, I know I've done everything I can for my clients, and I feel like I'm aligned with Munros in that same aspect of the way we do business. So yeah, it's really that's really nice just to get those emails every now and then, and I know that it's a genuine concern for my business and the way they look after their clients.
Yeah, brilliant. Oh, thanks for that. Okay, so why are we here? We're here to talk about home loans, aren't we?
Sure.
I'm pretty sure my video spotted. Brilliant. So we did part 1. That was last week. If you didn't join us for that, there is a recording. Just let me know and I can send you the link. And then, of course, we're recording today. So we're going to cover some of that stuff that you see there on your screen. Some of it's already covered in part 1. But, if you have any questions, whether it be on what we're talking about today or anything related to home loans, use that Q&A button, submit that question, and we'll answer it either throughout the webinar or towards the end. And the other thing to mention is, of course, we have to put the disclaimer there. We're not actually giving you advice for your specific circumstances. It's just general information today. So if you do need tailored advice, you need to speak with an appropriately qualified person in that regard. So, and then just lastly, before we kick into it and let Trish do all the talking, we put on these webinar series to impart the knowledge to you. So because we want you to basically achieve your goals, and we do that however we can to help you out there. So keeping that in mind, if you're not currently a client of Munros, then our suggestion is you make the switch to Munros and get this valuable knowledge and valuable service. And if you are currently a client of Munros, then I would like to say, Matt, perhaps if you can refer a friend, that'd be very fantastic. We love to help as many people as we can. And back on those 5-star Google reviews, submit a 5-star Google review. That'd be fantastic. So that's enough from me at the moment. Let's let Trish take us away. So let me spotlight you, Trish. And what are we going to talk about first?
So I thought we'd just do a quick summary in case any of you missed the last session, but just a very, very quick summary. We covered off why it was important to look at your interest rate and potentially review your rate and home loan. We also covered off a couple of different types of packages. So, you know, if you're getting an annual package with an annual fee or a basic style package. We talked about the importance of setting goals, using a budget, and just generally making sure that you understand a little bit about your home loan, but more importantly, that you're keeping your bank honest. And if you don't have time to do it, you know, as a broker, I can definitely do that for you. So kicking off this, this session, I feel like this session is going to be a nice juicy session, covering off lots of additional secrets and things, but it may also be quite specific to individuals. So I'll try and not go into too much detail in case the situation or the example doesn't apply to you, but we will be talking about investment home loans. We'll be talking about budgets, how to pay your home loan off faster, reviewing your home loan, some hints and tips when you've got investment properties on how to set them up correctly, and also how to maximise your negative gearing benefits. So we're going to cover off those things today. To get us started, we talked last time about having financial goals, and financial goals can be, you know, 6 monthly, annually, 3 yearly, or even longer if you wanted. But before you can really set a financial goal, you do need to really understand where you're sitting at the moment. So I'm going to bring up and share a screen with you, which will allow us to understand what sort of budget position you're in and what living expenses you're going to have. So I'm just going to bring that up now. Let me do that right this second. There we go. Can you see that all right?
Yep, it's coming through.
Perfect. So this is a living expense statement or living allowance statement. And this is something that the banks will want to see you complete prior to lodging an application with them. So if I can just sort of go through some of these things. I've just filled out a dummy one here based on some, you know, regular type of entries. But if we can work through this just quickly and come down to the bottom, your total, in this instance, total annual living expenses come around at $53,000 a year. So it's nearly one person's income. Now, this isn't including your mortgage repayment, just bearing in mind. So total monthly living expenses are $4,477. Now, if we have...
Trish,
yes.
So is this dummy number just something that you plucked out of nowhere, or is this like a relatively...
It might be close to what ours is. Yeah, it is very close to what ours is, and we're a family of 4, so 2 adults and 2 children. And I would say this is pretty bang on. We've got some of the things you might not have, the annual school fees potentially. You might own a business, so your car registration and insurance, that might be all written off. And also your groceries might be a little bit less than ours or more. Clothing, I like to shop, so I've got a good allowance in there for me. But yes, I mean, some of these things, to be fair, you know, phone, petrol maintenance, car registration and car insurance, they may come off your business expenses. So there's a big savings in that. But yeah, I've kind of just rounded it out. I would say, to be fair, we probably spend a little bit more on the fortnightly allowance for eating out and entertainment. And
yeah, where's say an Uber Eats fit? Does that fit in groceries or eating out?
No, that's eating out. That's entertainment. Yeah. And the bank will classify entertainment, the out-of-pocket childcare expenses, subscriptions, even I think they use education expenses as well as discretionary expenses. So they're the expenses you can really cut back on if you needed to. So if it was a matter of choosing a mortgage repayment or eating out, you're going to choose your mortgage repayment. So they're your discretionary expenses. So they're the ones that the bank might go, okay, well, you know, if times got tough, what could you remove quite quickly? Well, it'd probably be entertainment being the first one. So you just wouldn't go out and eat out. It might also be a lot of the clothing budget. So instead of $300 a fortnight, it might only be $100 a fortnight. So it just depends on where you think they align with your lifestyle. And I feel like this is quite conservative, if I'm being honest. I would think, you know, by the time we add a couple of trips down south and maybe a, you know, holiday out to Broome or something like that, that's going to be a little bit more.
Yeah. So this is COVID-19 holidays because you can't actually leave.
Yeah. All right. Let's call it that.
The country.
Let's call it COVID-19 holidays.
There's nothing in other.
There's nothing in other.
I know from previous experience the recommendation is don't put anything in other. Basically. Like if you can put it in another category.
Let me give you an example. If we're going to be applying for a home loan application, and you're going to have savings of $50,000 in a bank account, and then I'm going to look at your expenses and you're going to have, you know, $20,000 of holidays in there, the banks are going to take that into consideration because it's projected. They're going to look at the last 3 months, but they're also going to look at what you've listed down. So if you are going to go on a holiday in the, you know, 3 months after buying a property, then I need to include that in there. You might have already bought your airline tickets and paid for your accommodation, in which case that's going to show, and we're going to include it in there. But one thing to be prepared for is if you are looking to refinance or buy a new property, you really need to knuckle down for 3 months prior to lodging that application to get the best result for an approval. So there's a little secret tip for you. If you are thinking that you're going to be tight on the borrowing capacity, and you think the bank might not approve you based on your income and your living expenses, it might be worthwhile doing one of these 3 to 6 months prior to buying a property, just to make sure that you've got your spending down pat. And every first home buyer that comes and sits down with me, we do this together, because there's so many expenses that living with mum and dad you wouldn't know about. Rates, insurance, house insurance, health insurance, they might still be on their parents' health insurance. So, you know, it's really important that we sit down, because this could make a huge difference to whether they actually think they can afford that loan or not. And I remember when I moved out of my parents' house, it's a funny story, but if you bear with me, I'll tell you a little bit of it. I moved out and I was adamant I was not going to rent. I was working in the bank as a teller at the Wembley store, and I was adamant I wasn't going to rent. And my dad and me were clashing. We're having, you know, banter left, right and centre. And, you know, I was probably a bit of a messy teenager. But he said, right, that's it. You need to stop spending money on clothes and going out and everything, and you need to start saving. So what they did is they started taking board from me, and I was devastated. None of my friends were paying board. I was absolutely devastated. And it wasn't just, you know, $20. It was like $50, $60 a week. But to be fair, I was working full time. So, you know, it was forced savings, essentially. Yeah. They were teaching me the value of money. And I thank my mum and dad for this lesson in life. But I tucked away a lot of my income, and I saved really hard for about a year. At the age of 20, I bought a unit in Osborne Park. And I was so proud of this unit. And I bought it off a deceased estate. So I was paranoid about sleeping by myself for the first 3 or 4 weeks. Because I knew that it had been a deceased estate thing. So I was haunted by this unit in Osborne Park. But anyway, once I got over that, then I decided I could start eating. But I had no money. I had absolutely no money. I'd borrowed my absolute maximum, and I was driving a Suzuki Alto, which costs, you know, $20 to fill up in fuel. And I was just really stressed out. So I would go back to mum and dad's house and eat dinner, because I was I was so tight with my money. I had no money to play with. And that was back in 2000. I'm showing my age now. That was back in 2004. I think it was 2004, maybe 2003. And back then the banks would just, you know, they would lend you money, no problems. They wouldn't do these exercises. So I had no idea
Really?
what my expenses were.
None of this?
None of it. None of it.
Yeah,
So
what was the interest rate back then?
I was paying 7% when I first got my loan. So yeah, that was really an interesting exercise. And I moved out and I had a hand-me-down bar fridge. I had my single bed. I had hand-me-down TV, dining table from my boyfriend's, at the time, my boyfriend's parents. But it was my place and I was so proud of it. And I eventually, started adding value to it in my own little way. But one of the things that was amazing was my parents came over and gave me a bundle of money and said, this is for you. And I ended up by actually buying my new fridge, or a new fridge with that money. That was all my board. So what it had taught me was if I tucked away that little bit of extra money, that $60 every week over the course of a year, that was enough to buy a big ticket item. And that resonated with me big time. So that's probably the start of the journey for me into why I became a mortgage broker, was understanding that small sacrifices, daily, weekly, fortnightly, can make such a big difference down the track. Now I bought the unit for $164,000, and when I was on maternity leave the first time around with my daughter, we ended up by selling that property for $425,000. So that made a huge benefit. That sacrifice that I made at the very beginning was outweighed itself entirely, and it meant that we were able to travel around Australia and do a whole heap of wonderful things. So if you've got kids, if you've got teenagers, charge them board. Okay, Trish said charge them board. And then maybe give it back to them when they move out, like my parents did, if you can afford it. So yes, coming back to the living expenses, there was none of this previously. This is quite a new exercise, probably in the last 4 years. But it just goes to show how important it is, because you can get quite carried away on the entertainment budget. And if we said, okay, well, this entertainment budget's now going to go to $600, all of a sudden your monthly living expenses are over $5,000. So yeah, if anyone would like a copy of this living expenses spreadsheet, then let me know and I can email it through to you. And it's a good activity to do, even if you just sit down, have a glass of wine and fill it out, just to see what your monthly living expenses are.
And be honest with yourself.
Be honest, yeah. No one else is going to see it unless you're applying for a loan.
But on the honesty part,
yeah.
What happens if you're like, maybe playing with the numbers a little bit, send it to the bank? I assume the bank's...
Well, first of all, it would be me critiquing it. So I would be getting a copy of your statements and making sure, okay, you're telling me that your living expenses are $4,000. I can see your living expenses are $5,500. We might need to go with a different bank that gives you a little bit more in borrowing capacity. Because each...
So it's extremely important to be really honest here.
Yes.
The bank, the ideal bank for you,
might not be that first bank, because that first bank might only give you $500,000, whereas another bank might give you $600,000 on exactly the same figures. But it's just that their risk profiling is slightly different. Yeah. Okay. So, and some banks use 80% of overtime. Some banks use 100% of overtime. Some banks will add back depreciation and interest from your tax return. Some banks won't. So it's really a good idea to understand, for me to understand, I should say, what your statement of position looks like, what your living expenses are, so I can make the right decision when I'm offering the banks to you and giving you a selection of who we want to go with. So, because it's nothing worse than lodging an application and getting picked up saying, look, Trish, you've lodged an application to us, you've told us that your clients are living expenses of $4,000, but on the last 3 months worth of their statements, their living expenses were $10,000. Can you explain that to me? And it's really hard. It's a really hard conversation to have once you've lodged an application, because, you can imagine the awkwardness.
No, you want a smooth process getting it all through. I mean,
Correct.
It's stressful enough if you're buying a property, you're getting everything else organised, and you've got the finance, the deadlines.
Exactly. So if we go back to the living expenses, now if I just make an assumption and say that our income coming in per month is $12,000. Okay, so that's net income every single month that's coming in. What that means is the bank has essentially a difference of, and I'm going to use my trusty little calculator here because it's Thursday and later on in the week. So that means that based on your living expenses, you have $6,872 in surplus income every single month. Okay, so that's your basic leftover amount from what your spending is. Now that is how they will use, that is the figure they will use to work out how much you can borrow. So
Trish,
yes,
just got a question here from Eric, a good one.
yes,
To mention. Where to go? This bit, there it is. He just said, are these figures pre-tax dollars?
these figures are pre-tax, yes. So if you are looking at, oh, sorry, you're talking about the $12,000, Eric? I'm assuming you're talking about $12,000.
Yeah, well, yeah.
So that's the net figure, sorry. So they're after tax.
Yeah, yep.
After tax, yep. Thanks, Eric.
Great question.
Yeah, so this is the money hitting your bank account. So $6,870 is left over. The bank's going to work out based on your mortgage repayment if you can service that debt based on that leftover amount. Now, if you were a first home buyer or you were buying your first property and you came to me and you said, Trish, we get $12,000 in our account every single month. Our living expenses are $5,000. I'm just going to change that. Oh no, I'll keep it there. Our living expenses are $5,000. I might turn to you and say, okay, great. So just based on those figures, you should have about $6,000 in savings every single month. $6,000 in savings every single month. They're going to turn around and go, no, we don't. And then that's the question, well, where's that money going? So they might be paying rent. So there might be a couple of $1,000s going in rent. There might be some other expenses that we haven't included. So then we can go back to our living expense calculations and work those out. But realistically, what we want to do is see where your money is going and your capacity to repay that mortgage. Which leads me on to the next part. When we are, and if I can just switch out of this screen, Drew, if that's okay.
Of course.
And go to another quick screen. Can you see this screen now or is it not?
We're still on.
Right.
Still on that spreadsheet.
Give me a moment. I'm just going to do a new share. Sorry about that.
Yep.
How's that?
That's perfect.
All right. So what I wanted to show in this example is if you were looking at borrowing and you had a mortgage, of $400,000 and your monthly income was $6,000 left over. It's gonna work. $6,000 left over. And the interest rate was, let's go with 2.8%. You're actually going to pay that loan off in 6 years. All right, so your income at $12,000 as a net income coming in, you would be able to pay that mortgage off in just over 6 years.
Yeah, that's unreal.
Yeah. So the living expense tool is amazing to work out exactly what you could be paying into your mortgage. Now, I'm not saying that that's feasible because you want to go on holidays, you want to do all those kinds of things. But if you can be really, really honest with yourself when you do that living expenses calculator and say, look, Trish, actually, that's probably not realistic. Let's change the figures. We're probably, based on an income coming in of $12,000, we're probably going to be spending $8,000 a month. So we've got $4,000 left over. Well, that's still okay because you're not paying it off over 30 years. You're paying it off over just over 10. Okay. So if we go back to working out what the minimum repayment on a $400,000 mortgage is, and I'll just calculate that separately, what we want to see is what are your minimum repayments on $400,000? Because that's what most people do. They just make their minimum repayment every single month and they don't think anything more of it until someone comes along like me and says, did you know that if you put an extra $1,000 into your home loan every single month, you could have your loan paid off in, 15 years. So if I can...
There's a massive difference too, the earlier you do that.
Yes, 100%.
So the bigger that loan percent is, the more
Yes.
your repayment's just paying off the interest.
That's exactly right. So Drew, if I can point you to this point just here, total interest paid. So on a $400,000 mortgage, if you just make the minimum monthly repayments, which in this case are $1,643, you are actually going to pay nearly, well, over $190,000 in interest over those 30 years that you have that mortgage. And that's just paying the same amount every single month.
That's like such a big number when you
It
look
kills
at it
me.
like that.
Yeah, it kills me. So what I say is, well, can you potentially lift that to $1,700 a month? You know, there's not a lot of difference.
Yeah.
$1,700, you might get a pay rise. You don't even notice the change. But just watch this total paid interest amount change. So $1,999,000, $1,888,000. Okay, so $10,000 off. Then we start getting exciting. We're getting excited about how much extra we're going to pay in. So this is where you can play around with the figures. Now, when you first get your home loan, you might not be able to pay the full amount because you've got furniture to buy, you've just moved in, new bills, you're trying to sort it out. But this is where the annual review becomes really important. And this is what I do with my clients. Buy your first home or buy a home, and then we set it for a year, maybe two, if you're feeling like you've got young kids or something. But in the third year, like I did with that example for that client, we're ringing up, we're finding out, is there anything extra you can pay? And then we're making those changes. So let's just say at this stage, we're able to pay $2,400. All of a sudden, the interest is dropped again by an 80 odd grand. And that's interest back in your pocket. Now with $80,000 at retirement, how much extra does that give you? Huge amount, absolute huge. That's a new car, that's 3 or 4 holidays, that's
Well, even, and if
money for
you
your
actually
grandkids.
invest that, there's the magic of compounding interest or earnings, and that 80 grand, just as this interest rate can be so much.
Yep.
You know, the 80 grand could be 200 grand if
That's
you invest
exactly
it
right.
over a number of years.
Yeah, or you've got a lot of self-employed clients probably listening to this webinar, but you know, sacrificing into superannuation, you know, that's going to be huge too. So the idea is for me as a mortgage broker to assist you to get your loan paid off as fast as possible. And by making tiny little sacrifices like I did when I was paying my board, tiny little sacrifices over a small period of, you know, time, weeks, fortnights, maybe months, it's going to make a huge impact down the track to your mortgage. So this is the number one. I think this is the most useful tool that I offer when I sit down and have a meeting or an appointment with a client. Now, I'll show first home buyers this. I'll show everybody this. I pull this out all the time and I show them and I say, this is why it's so important to pay off debt as soon as possible. Yes, you're going to pay your loan off, but look at the total amount of interest that you've now paid. It's substantially less. All right. So if anyone wants a copy of this calculator, more than happy to share it as well. So
yeah, I'll grab one.
Yes, okay, I'll send you one. So, you know, what I generally say is open a folder in your inbox, call it home loan, call it leading edge finance, call it Trish, whatever you want to call it MUNROS, and pop all these tools into that inbox so it's ready to go. And if you're ever sitting there and looking at your finances, you know, and you're like, geez, I really need to get this mortgage paid off, open up one of these tools that I've sent you. Just open it from the inbox so that the figures don't get corrupted and things, and play around with the figures, because, you know, this is 101 of what every Australian should have access to. And I tell you, the banks do offer these calculators. These are called amortization calculators. They do offer them, but it took me, I ran the test a couple of weeks ago when we were talking about doing this webinar. It took me 10 minutes to find a calculator, this calculator that I was looking for on a bank website. 10 minutes. And I know my way around bank websites because I'm on them all the time. So, you know, banks don't necessarily want you to know this stuff, because for them, they're saving themselves, well, they're wasting, they're not able to earn, get the right words, they're not able to earn $80,000 worth of interest from you if they tell you this, you know, or they show you this example. So paying more than you need to on your mortgage, especially with interest rates being so low, is so important. Now, if we just dropped that, in that example that I explained to Drew earlier today when we met about that customer dropping their interest rate, they were on 3.32%. Okay, so that was their interest rates. And I'll just change their loan amount. All right. And if we look at this, I think that they were paying around, sorry, I need to reduce that down a bit more. 221. Right. There we go. So the total amount of interest that they were going to pay over the term of this loan was $306,000. So we were able to drop their interest rate to 2.33%, and we were able to, based on our discussions, increase this up to $2,400. We've halved the amount of interest in just one phone call to them.
Wow.
All right. Now that's that's 2.33 is a 3-year fix. It's not going to last for the lifetime of the loan. But what's going to happen every single year potentially? They've got 2 small kids at the moment. They're going to be becoming older, potentially not going to be paying daycare and all the extra costs that go with young kids. So they might have capacity to work more hours. So at the moment we've got one person working full-time, one person working part-time. After 3 years, that person might be able to work full-time or pick up an extra day. So then we can sort of say, okay, well, perhaps in 3 years, we get to the point where we can increase this amount by an extra $200. So here we are. We've now shaved another portion of interest, another 10 or grand off the loan. So as you go along in life and you start to either earn more, your mortgage doesn't change, hopefully, start to earn more and start to put more money away. And you can see the differences, okay? So hopefully that helps. If the interest rates go up, then you can play around with those figures too. Obviously at 2.33, we don't know what the interest rate's going to be in 3 years' time, but you can sort of do some projections. If it jumped hugely, you can sort of play around with those projections as well. So
I suppose to be on the conservative side, if you wanted to, what were the interest rates, say, a year ago before all this happened?
I would probably add 1 to 2% on the interest rates on the variable rate at the moment. So the variable rate's hovering around the 2.5, 2.8%.
Yep.
I would add 1 to 2% on that and work on that as a budgeting tool. So
if you were like 4%, as you put there actually.
4.5%. Sorry, I'm corrupting all the figures now. 4.50%.
Yep.
Just disregard that one. But yeah, so you'd be looking at $1,893 based on a $500,000.
Yeah, so you can like do your sort of worst case scenario for yourself. And,
yes.
It's all about risk tolerance.
That's exactly right. Yeah. So, good calculator to play around with. And I've really corrupted the calculator. So that's why I say keep it as a,
I particularly like this one because you can adjust at the different year levels. Like those ones which are on either the bank's website or other websites, it's typically just, this is it over the life of the loan, whereas this one you can play around a bit.
Yeah. So
I can see where your clients are getting a lot of value out of this because you can actually see the dollar figures. And, it comes, it's really
it's quite a powerful tool.
Yeah, powerful is definitely a good word. Yeah, because to go from that 300 grand in interest to 150 grand before, that's huge.
Yeah, it's nearly another house. It's a deposit on another house. So yeah, really important that if you can, and it's not about, one thing that I'm very conscious of is when we go back to talking and doing annual reviews, it's not about changing your lifestyle dramatically. It's not about that. It's just about knowing that you're living within your means. And I have mentioned that in the last session, but living within your means is such a big, we're a consumable society, and if you can live within your means and know roughly what your income is and what your outgoings are, you'll just be so much more happier. And a lot of relationship breakdowns, people come to me and the first thing they say is everything's a mess. Financially, it's probably the reason why we separated in the first place, because there's that pressure, constant pressure on working so hard and then not knowing what no one's on the same page. You're not on the same page. So you might have one person in the family that's a spender. Yes, that's me. And believe it or not, and then you've got another person who's constantly saving, and they're feeling like, oh my gosh, like you've just gone out and bought another jacket, or you've just gone out and bought another pair of shoes. You know, that could be money off the home loan. So it's collectively sitting down together, making sure you're both on board. And writing the goals together. So set some goals. You know, how much can we increase our monthly repayment to in the next year? Add an extra $200 on that.
Yeah, spot on. Now, Trish, I just actually looked at the time. Couldn't believe it. 10 minutes
we've done
past
it again.
10 already.
Sorry, guys.
It's unbelievable how quickly the time can fly.
I know.
So we better make sure that we stay on track here.
Right. So can we stop sharing this screen?
Yeah, I think that'd be a good idea. Now everyone can see me.
There we go. Sorry, Drew. I've messed it up.
No, it's all good. I'm sharing. I'm going to share. Here we go. Brilliant. Okay, we're back on the slides.
So we've already covered off the first 2 points. So having financial goals and budgets. Using an offset account. We did touch on that last time, so I'm not going to go into too much detail about that right this second. We've talked about paying extra onto your home loan and how that changes your interest that you are charged over the life of the loan. And then obviously using that amortization calculator or the debt down calculator and reviewing your home loan interest rate. So we've done all of those things. And just moving on to the next slide, what we want to talk about now is, I'll wait for Drew to catch up. Can you switch us there? Beautiful. All right, so how can you ensure your home loan is working its best? So I'm going to cover off a little bit of information now on quite a high level about investment properties and the best way to structure them. So if you were to go directly to a bank and you've got a home loan at the moment and you said to the bank, look, I want to buy another investment property, they would go, great, we can use, well, they potentially would go, great, we can use the equity in your existing property to use to buy this new investment property. And what they do is they cross-collateralize the securities together. So they use your own home and your investment property, and they say, right, the total value of that property is $1 million, those properties is $1 million. The maximum we're able to lend on that is $800,000. So that's called cross-collateralization, sorry. As a broker, we don't like this. We like them to be what we call standalone securities. So you have one loan and one property. Now, the reason for this is if down the track you decide you want to sell your owner-occupied property, you don't have to pay out your investment loan. You can keep your investment property and the loan linked to each other. And the big problem that we have is if you were to pay out your owner or sell your owner occupied property and you were using your investment property as security, the bank may make you use those funds that you've got left over instead of buying the new property to pay down the loan, the investment loan, which then isn't going to work from a negative gearing point of view, because once you pay that loan off, you can't then re-borrow that money to the value of the property without incurring some sort of tax disadvantage, because and Drew will tell you a little bit more about this. I'm sure he'll answer a few questions, but when you draw down on an investment loan, the purpose must be for investment purposes. It cannot be for owner-occupied purposes. So if that scenario happened to you and you wanted to go out and buy another owner-occupied property, and you wanted to take the funds out of your investment loan or use those funds that you put in there to reduce the interest to buy an owner-occupied property, you're going to be penalised. You're not going to be able to claim the full amount of the interest on that property, on that loan, I should say.
So I think like the way to look at it is, unfortunately, this happens quite often where someone's got an investment loan. Now it's mortgaged to the investment property. So I think, oh, yep, anything on that loan is always going to be tax deductible against that rental property. It's not always the case, and because it comes down to actually what is the money used for. That's exactly
correct.
What you're saying. So what happens is like someone might as you say, might get an inheritance, maybe win the lotto or something, or they just say sold, maybe their own home, and they've got a bit of an excess at the time. So they think, well, I'll put this on the investment loan because I don't want to be paying interest on it. The trouble is, if you then put it on the investment loan, reduces that down. So say it was 400 grand loan, now it's a 200 grand loan, and then you subsequently redraw that 200 grand out to buy your new home, do some renovations, to go on holiday, whatever you're using. If that redraw money isn't used for a income producing purpose, so it's used for personal use, that 200 grand on that loan, the interest you're paying on it, it's no longer tax deductible.
That's correct. And
then and you've locked it in. Once you've done that, there's no reversal. You can't easily fix that up, unfortunately. So we do come across that a little bit too often, I would say. And it's generally because no one's taken the advantage to give Drew a call, or Mike, or even possibly Trish, just to say, I'm thinking of doing this with my loan. What is this? Does this sound right? So Trish can't give you the tax advice, but she can certainly say, well, maybe not. Maybe you need to speak with Drew.
Yeah, and
so that's an important part.
Yeah,
sure.
That's exactly right. What I could say to you, if you had called me prior to selling that property, is I would say, look, why don't we look at setting up an offset account against the investment property, or the investment loan, so that we can put those funds into the offset account, and then it's not paying down that loan, it's just saving the interest. And the advantage of that is it's not touching that loan, it's just in an account. We can realign the offset to the offset account to the investment loan. Because as Drew said, I can only give general advice. I can't give tax advice. But I see it
you're spot on there
all the time.
The offset account, that's the magic of an offset account.
It is, yeah.
Because that money, it's sitting in a separate account.
Mm-hmm.
When you take it out and you use it for, whatever, your holiday, you haven't changed the tax deductibility of the underlying loan.
Yeah.
Yeah.
So from a tax point of view, you would still be able to, just for that month, the interest might be $200, but then once you take that money back out to buy your own place, the interest will go up to, $600-700 for that month.
Yeah.
And you're none the wiser as far as the accountants and ATO goes.
Yeah, and if you've got two loans, one owner occupied, one investment.
Yes.
From a tax deductible point of view, you want to be paying down the home loan or having that interest reduced more compared to the investment one.
Yes.
You get the interest.
You might have heard before, we like to refer to it as good debt and bad debt. So your good debt is your investment debt because you can claim a negative gearing portion on it. And your bad debt is your owner-occupied debt that you can't claim anything against. So we would always work with trying to pay off your bad debt first, which is your owner-occupy loan. So you might set your investment loan as interest only to maximize how much extra you pay into your owner-occupy home loan. And that was what was happening a few years ago. There were financial advisors giving advice out there. Make sure you set your owner-occupy home loan as principal and interest and set your investment loan as interest only. But as we know, the banks have different rates for all those type of loans. So if you've got an interest-only loan, it's generally higher than if it was a principal and interest loan. So it's a real case of crunching the numbers and actually working out, can you afford principal and interest on both of those loans? And if you can, that's great. Let's set them both as principal and interest. But let's make sure that on the investment loan, you're only paying the minimum repayment, but on your owner-occupier loan, the bad debt, you're paying the maximum you can to reduce the amount of interest that you're paying and effectively pay that loan off as fast as possible because there's no tax benefit to you.
Yeah.
All right.
Spot on.
The other one I just wanted to point out on that is with relation to offset accounts, if you have an investment loan or multiple investment loans and you do bank with one of those banks we mentioned last time, you can actually set up those offset accounts to have them related to each of those properties. So let's just say you live in Hillary's and you've got an investment property in East Perth. You can actually have an offset account linked to the East Perth loan or aligned to the East Perth loan, but the offset account offsetting your home loan in Hillary's. Then additionally, you might have another investment property in Fremantle And in Fremantle, you have the loan set up. You've got an offset account sitting next to it where you've got your rent coming into it. You might have some, you know, plumbing bills, some strata levies coming out of that account. But that offset account is also linked to your Hillary's property. And the benefit of that is you can have up to 9, 10 accounts, depending on how many investment properties, but they're all linked to your Hillary's property because we just align that in the back end of the bank.
Yeah, that's fantastic. I never knew about that.
Yeah. And from an accountant's point of view, and correct me if I'm wrong, but I believe that having all your income and all your expenses just in one account, not all over the place, makes it a huge attraction when you're doing your tax return at the end of the year, because you just have to give one statement for the year and it's got all your incoming rent and all your outgoing expenses.
Yeah, 100% right there, Trish. Yep, keeping everything nicely all contained in the same accounts. It's the same with running a business. You know, if you've got it all there. This way, we're not going to miss anything. You're not going to miss anything. You're going to, nice and easy, bang, get the statements together, send them off to us, and we know it's all there and well contained. So very good point.
And so, yeah, Drew, Mike, they're not going to know which account it's offset, or even if it is an offset account. It's that's all done in the background of the at the bank. So by doing that, you are going to maximise your negative gearing benefits because you're only making the smallest amount of repayment on your investment loans, and again, maximising the repayments on your own occupied debt. Okay, so I'll move over to the next slide because I'm conscious that we're going to run over time. But the borrowing capacity and using your equity in your mortgage, there's options down the track. So let's just say you've got your home loan and now you're looking at, you know, going on a holiday, buying a car or a caravan. Now these things they're not related to the home loan. They're what things you want to do. So one thing that I talk to my clients about is maybe not setting those particular purchases over a 30-year loan term. So what I mean by that is if you've got a $400,000 mortgage and you come to me and say, Trish, we really want to buy a new car and a caravan at the same time. We want to travel around Australia. I'll go, fantastic, that sounds amazing. Let's have a look at the income and expenses. Can you afford to do that? Instead of tying that, say, I don't know, $80,000 into your mortgage and making your whole mortgage now $480,000, what I might suggest is, well, let's keep your mortgage at $400,000, but let's take this $80,000 over a 5-year loan term, still using the equity in your property, but 5 years, because it's a want, it's not a need, it's not an appreciable asset. These assets are going to depreciate over time. 5 years will give you a much higher loan repayment, but you're going to have that paid off in 5 years' time. You can still take advantage over the low interest rate on the home loan, so you're not getting a personal loan at the car dealership for 6-7%. You're still using the home loan rate around 2.8%, but you're taking it over a 5-year loan term, which means you're not tying that debt into your property. And I think that a lot of people, when they refinance from bank to bank, they just default their home loan to 30 years because that's what the bank sets up, and they don't think about it. So you might be, I don't know, at the age of 35, 36, you've had a mortgage for 6 years, yet your loan term on your home loan is still 30 years because you recently refinanced to get a better interest rate, but you're now paying it off over another 6 years. So when you refinance from bank to bank, or when you look at, you know, doing a purchase, making a purchase, it's really important to understand how is that going to impact the amount of interest you're going to pay for the next 30 years. And when you make that decision, you need to look at, okay, what sacrifices am I going to make now? And that might be paying an extra, you know, $800 a month to pay off the caravan and the car, as opposed to just paying $200 a month. So yeah, that's probably a huge tip that I see a lot of people doing. And I think it's not financially viable to do that, because why would you add more debt to your bad debt and then finance it over 30 years? So yeah, that's probably a good tip on that one.
It's a really good tip. And on that, it seems from what we're talking about here, all the conversations, life's changing and all that. You've got this loan, and all of a sudden, if you refinance, you might have another 30 years.
Mm-hmm.
I think it all sort of starts to come together and say, man, I really need someone to help me along this whole journey.
Yes, that's what it is. It's a journey.
So you might go in, I suppose, I would have gone into my first home loan, just like, yeah, got a mortgage broker that helped me out, without really appreciating, oh, gee, the broker's going to be there for a number of years helping out as my circumstances change, and that'll be the same basically for everyone, I would have thought.
Yeah.
So actually, it's a critical step to make sure you're getting someone who knows what they're doing is going to be there.
And I guess it comes back down to that passionate, how passionate I am about what I do. And, our dad gave us a good piece of advice. He said, find something that you love doing and then find a way to make money out of it.
Yeah, I love that.
Yeah, and, if you can share one piece of advice with your kids or with someone who's coming out of high school, I think that would be the number one piece of advice that, that's resonated with me over my career. And I have taken jobs when I was in the bank. I took managerial roles and, they weren't for me. I didn't understand why. If you don't like being at work, why are you at work? Go find something you love doing. You spend so much time doing it. So, that's one thing that's really stuck with me and resonated with me. And I guess mortgage broking for me is about helping people and, giving back the secrets that I know to save people money and ultimately help them live their best life, which I think aligns us, Leading Edge Finance and Munro, is so similar, because that's ultimately what we're looking at doing, is making life easier for you, but making sure that you enjoy life at the same time and still go on those holidays and that kind of thing. Yeah,
so on the secrets, so we're getting towards the end here. We do have a couple of questions. So get your questions in. We're going to go slightly over time, I expect, but get your questions in so we can answer them very soon. Did you want to have any final say before we get into the questions? Otherwise, I've just pulled up a list there if anyone is having a think about what questions they might want to ask. There is a list up in front of you on some of the topics we have touched and have not touched. But yeah, Trish.
So in summary, I would say I'm not out to, if you've got a fantastic representative that you deal with at the bank, then that's fabulous, because not everyone has that. But if you have not sat down and done a budget, or if you have not actually looked at how much interest you're paying, or, where your mortgage is at, what your financial goals are, those kinds of things, then now's a better time than ever. Coming up to the 30th of June, fresh financial year. Most people celebrate the end of the year. We celebrate the end of the financial year. And I just think it's a really good time, to sit down with someone that you trust and someone that knows the ins and outs about mortgages and the way they work, so that you can maximise your benefits to pay your mortgage off faster or get into the property market sooner, knowing all the information that you need to know. So I'm here. I've had a great response from the last webinar, so that's kept me nice and busy. So but I work after hours. I can come and see you at your home, sit down and chat through any scenario you like, or weekends, or I can come to your office. So really flexible, and again, I genuinely love what I do, and I just want to help West Australians out there save as much money as they can, put it back in your pocket. So that's it.
Fantastic. All right, so submit those questions. This is a last sort of reminder. We have been recording today. I trust that the recording's working. So I'll send you the link once it's processed and up and running. As mentioned in part one, at MUNROS right now, we're doing a number of smart tax plans, helping people understand their tax situation and plan for the year ahead. So if you need some assistance with that, let us know. Otherwise, let's dive into the questions. So we've got one here from Diego. Diego says, what are the advantages or disadvantages of paying a 5% deposit versus paying a 20% deposit on a home loan? Are there any hidden costs with a 5% deposit? Brilliant question, huh?
That is a great question. And the 5% deposit, so most banks require at least a 5% deposit. 5% deposit will attract lender's mortgage insurance generally though. So lender's mortgage insurance is an insurance that protects the banks as opposed to protecting you. And the reason the banks require you to take that insurance out is because you're deemed higher risk to the bank. So if you had a 20% deposit, then you are lower risk because the loan value versus the property value there's a bigger difference in there. So if you were to default on that loan, they've got a bit of a buffer in between that, but with that 20%. So the 5%, you will pay lender's mortgage insurance. If you can have the 20%, then it is far better to have the 20%. But one thing you've also got to take into consideration is how much rent are you paying at the moment, potentially, to get to that 20%. So how far behind in the market are you going to be to pay that 20%? It might be worth in your circumstances to pay between $5,000 and $15,000, maybe more, depending on the value of the property, in lender's mortgage insurance to get into the property market and stop paying rent. It might be, I had a customer a few weeks ago who just wanted security. They'd been moved in their rental property about 4 times in 2 years, and they had 3 young kids, and they were like, Trish, we just want the security of having our own house and not thinking constantly, when are we going to be kicked out of this rental property? So for them, paying lender's mortgage insurance and paying $15,000 to get into the property market and have that security for having their kids going to the same school for at least a 2, 3 year, 4 year period far outweighed the cost of lender's mortgage insurance. So it really does depend on every single person. If you can avoid it, then do so, because it's effectively, once you've paid it, it's dead money. You won't get that money back. But if it's going to take you a long time to save it, then you've kind of got to weigh up what you're going to lose in interest over that period of time. Hopefully that answers your question.
Yeah, brilliant. This is actually going to really segue into this next question that we've got. And it's the final question, unless anyone else wants to submit one. It's by Eric. So Eric says, assuming we aren't in a position to afford both a owner-occupied home and an investment property, and also we don't currently own a home, is it better, from a long-term investment point of view, to buy the investment property and continue paying rent, or buy the owner-occupied home?
Yes, that is a good question. It really depends. So if you don't have a deposit at the moment, then you would need to obviously save up for that at least 5%, maybe 10%. With investment properties, the banks probably would want to see a little bit more than 5%. They'd probably want to see 10%, because you're going to be renting that property out. So you would need to save a little bit more than 5%. You would also need to save, Eric, I'm assuming that you are a first home buyer. I'm sorry if I've made the wrong assumption there, but you would also need to save your stamp duty as well. So as a first home buyer, if you are buying under 420,000 or between 420,000 and 520,000, you actually get the stamp duty, a lot of the stamp duty costs are waived. So if you
just to point out, that's the WA figures.
Yes, that's WA figures, yeah. So if you are looking at buying for an investment property, yes, you'll be getting rent on that property. You'll get you into the property market. You'd want to see substantial growth in that property to make it worth your while. But I think the big thing is going to be the upfront cost to get into that property. And if you are doing it for an investment purpose, then there might be other investments out there that are better suited to you rather than jumping into an investment property. And the reason I say that is because to get into the investment market, it's really expensive. The stamp duty and fees are usually about 5% of the purchase price. And then you've got interest ongoing. And that's before you've even, made any money in return in the value of the asset. So I think in your situation, it might be better to sit down and work through the exact figures and look at what your plans are for the next 5 years, because it might be worth buying that property, living in it for a 12-month period, so you claim the first homeowner's grant and the stamp duty concession, and then potentially looking at renting it out after that fact. So, and that is an option. So you only have to live in the property for a period of 6 months within the first year to qualify for the first homeowners grant. And I do apologise if you're not a first home buyer. I have made an assumption there, but maybe we can take that one offline if you want to chat in more detail.
Yeah, and it's like this question in terms of investment property or owner occupied. Like it was one I faced. I was pretty anti-property about 5 years ago because I was like, it's way too expensive, right? It's way too expensive.
And now look at you, you're getting another one.
Yeah. So it was only about a year ago I bought our home, and it was only about 6 months before then. Me and my wife were over at Universal Studios over in California, and we're just waiting in the line. I just turned to Kira and I said, I think it's about time we buy a property. I'm thinking the prices are about right. She basically almost fell over there. She's like, where'd this come from? But I'm an accountant. I was sort of running the numbers.
Yeah.
I was sort of bored in line, sort of running the numbers in my head. So I said that, and also because like renting, I didn't mind renting too much, gives you a bit of flexibility, but it depends on what stage of life you're at. So we're getting towards having children and wanting a bit more of that security, as we were pointing out. And definitely Kira, she wants to build up the house.
Yeah.
This is one of the dangers of getting a house. Once you get a house, you want to do a bit of renos. So we just finished up bathroom renos, but I won't go on there. But anyway, so we did that, and now we're looking at the investment property because the opportunities there. The Perth market, I mean, from my point of view, I've run the numbers, and the rental yield that you can get, we're well covered in terms of affordability there. So that's the approach we've taken.
Yeah.
I think it's a very similar approach to what's generally spoken about in the financial world. Mr. Barefoot Investor is always saying, buy your house and then use, because it's like 4 savings that we were actually speaking about just earlier, Trish. It's 4 savings, get you into it, and then you look at, okay, what are the investment options? And property might not necessarily be the only investment option. Like for myself, I was also considering other options like the share market, and that I just found, at least for our situation, investment property was the right way to go at this time. So there's just a bit more input for you, Eric. So that draws us to a close on the questions. Thanks very much for the questions submitted there. If you do have any more, of course, just let us know after the webinar. Myself or Trish would be happy to get back to you and help out where we can. So just to close up there, once again, if you're not currently with MUNROS, then we would very much like to help you out and say, can you make the switch to MUNROS? And if you are a client of MUNROS, we'd love for you to refer a friend and leave us a 5-star review. So thanks very much, Trish.
Thanks, Drew, for having me.
Fantastic webinar series we've put together. If you want to give everyone a wave, let me just spotlight the video. A wave goodbye.
See you later.
Brilliant. And thanks everyone for hanging around. I just gave a wave, but no one can see me. There we go. There you go. Gave a wave to Trish. So yeah, just let us know on your way out if you need anything. Otherwise, thanks very much. And I'll turn the recording off now. Cheers.